Welcome, everyone, to the Financial Literacy Seminar Series. Today, John Gathergood is presenting Naive Buying Diversification and Narrow Framing by Individual Investors. John Gathergood is a professor of economics at the University of Nottingham. His research focuses on understanding consumer behavior in financial markets. He publishes in leading academic journals in economics and finance, such as the American Economic Review and Review of Financial Studies, as well as journals in a wider range of disciplines, including the Journal of Marketing Research and Social, Psychological, and Personality Science. He has conducted research in partnership with Argus Analytics, Barclays Stockbrokering, Experian, as well as other firms. He's also undertaken pro bono advisory work for the third sector, including the Money Advice Trust and Step Change Debt Advice Charities. Much of his research involves collaboration with firms and policymakers on research useful for both knowledge and practice. To the audience, please submit any questions you have through the Q&A, which we will monitor. And I will ask any clarifying questions during the presentation. More in-depth questions I will leave to the Q&A at the end of the presentation. John, you have until about 4:15. The floor is yours.
Brilliant. Many thanks. Many thanks, Vitaly. Many thanks, Anna-Maria, for the invitation. It's a pleasure to speak this evening here in England. And this paper is joint with a number of co-authors, David Hirschleifer in California, David Leake at Lloyds Banking Group, and then Hiro Sakaguchi and Neil Stewart at the University of Warwick. And we've called it Naive Buying Diversification and Narrow Framing by Individual Investors. And so our paper begins with the observation that when faced with financial decisions in a range of domains, people often adopt really quite simple rules. And some of these have been around in economics for a very long time. So the notion of individuals saving a fixed fraction of their income, or for example, choosing a mortgage contract to keep payments at some preconceived target value. And if individuals adopt these simple rules, and let's call them heuristics, then that raises the question of whether or not they are good or bad approximations of rational or maybe quasi-rational behavior. And so understanding the heuristics that agents use is important for realistic models of behavior, but it's also important for policy design to understand how policy might work in a heuristic-driven world. Now, a very common choice, and the choice that we study in this paper, faced by investors is how to allocate investments across multiple stocks. And this is, of course, a domain in which the notion of rationality is well established, and there's a clear benchmark in that portfolio theory determines what optimal diversification looks like, and that's been known in the literature for some time. But evidence shows that in practice, individual investors tend to deviate substantially from what's optimal, and in at least two ways. Either first by not participating in risky asset markets and the long-standing puzzle of limited stock market participation, or among those individuals who do participate in risky asset markets, tending to under-diversify when they participate. And there's, of course, an extremely large literature that studies the lack of participation and tries to understand the behavior of investors who do participate. And one major explanation for lack of participation and under-diversification is narrow framing, which in its most general form is a tendency to make choices in isolation instead of an integrated overall decision. And this is one lens through which we can understand non-participation. If investors fail to appreciate that the stock market doesn't vary perfectly with other components of the investor's portfolio, such as real estate, they might perceive investing in stocks as just taking on additional risk rather than taking on diversification. And then you can apply that to within the portfolio of stocks, and investors might fail to appreciate that each stock is imperfectly correlated with the rest of the portfolio. And so again, consider the marginal stock to be more risk rather than diversification because they are thinking very narrowly. Now, in this paper, we're going to examine narrow framing in a very fundamental way in the way that investors build their portfolios. In particular, we're going to go to the very basic question of how investors coordinate new purchases when they buy stocks with the current holdings in their portfolio. Now, we might expect, and of course, portfolio theory assumes that when investors are building a portfolio, they're trying to achieve some target level of holdings. They're trying to optimize and build a portfolio position. And of course, portfolio theory recommends mean variance optimal holdings, or the literature might suggest that a simpler way to think of a portfolio construct, such as a 1/n weighting in the portfolio as well established, is a feasible weighting system that investors can use. But what we're going to show in this paper in brief is that when investors build their portfolios, they seem to focus on their purchasing behavior separately from their holding behavior. In particular, we're going to show that investors do use that 1/n heuristic, but they tend to apply it to their purchases. That is, splitting the money they invest on a particular day equally across a number of stocks that they buy on that day. They don't use that rule as a portfolio rule, making purchases such that the portfolio is in 1/n balance. And so that's why we've called the paper Naive Diversification and Narrow Framing. Investors do naively diversify using the 1/n rule, but they apply that rule to their purchases on the day, splitting the monetary amount, appearing to narrowly frame their purchases and not buy such that they achieve a balanced portfolio. And hence that's the inspiration for the title, and that's really the crux of the paper. And so our contribution, of which that is the essence, shows a number of things. So firstly, we show that the phenomenon of investors buying multiple stocks on the same day is quite an empirically relevant thing in investor portfolios, and something which is arguably understudied in our sample, which is going to come from one of the big three stockbroking firms in the UK. A little less than a third of the total amount invested in our sample, which spans a 2-year period, is invested through these multiple stock buy days, when investors are buying multiple stocks on the same day. And indeed, investors do commonly split their buy day investments 1/n, but they're using 1/n as a buy rule, if you wanted to call it that, not as a portfolio balancing rule. And so that's why we call it naive buying diversification. And what we don't see investors doing is what the literature might recommend, and previous studies suggest as well in practice, which is naive portfolio diversification, as in the D. McGrell co-author paper. And then we study why investors appear to be using this naive buying diversification rule, splitting the buy day purchase amounts evenly across the stocks that they buy. And we consider different hypotheses as to why this might be the case. In particular, what we call the stock picking hypothesis, or the diversification motive hypothesis. So the stock picking hypothesis is the idea that investors arrive at this 1/n naive splitting because they're very focused on the choice of stocks, and they're not making an active choice to diversify, and they use 50-50 weight for 2 stocks as a simple heuristic, absent any more sophisticated strategy that they're attempting to apply. So their stock picking is the focus of their activity, not their diversification, and the 1/n is a go-to intuitive way to split money across stocks. In contrast, we also consider what we'd call the diversification motive hypothesis, which is actually that an investor who maybe has thought of buying a single stock decides to buy a second stock, and so makes some attempt to diversify, but does so naively. That is, using 1/n. And so the difference between these hypotheses is that in the first case, the investor is very much focused on picking a number of stocks without thought to diversification. Whereas in the second case, you could say, well, naive diversification is better than no diversification at all. The investor chooses a first stock and then tries to find a different stock, and we'll define different later, in order to diversify, and then uses the naive rule, anything absent a more sophisticated strategy. Now, we actually find much more evidence for what we call the stock picking hypothesis. So these investors act as if they're picking stocks without considering diversification, either in the choice of stocks or in the naive rule that they use. And then towards the end of the paper, we consider the portfolio performance of naive buying diversification, in particular in contrast to naive portfolio diversification, which the DeMiguel paper and the broader literature suggests delivers good returns compared to the benchmark of the optimal portfolio. And we show that naive buying diversification delivers worse portfolio performance, especially when stocks are uncorrelated with one another, because intuitively the investor is diversifying on a margin that doesn't ultimately matter for mean variance performance, which is the buying margin rather than the holding margin, which would be the relevant margin if one were interested in portfolio performance. And then we also consider, well, why is it that my investors might be drawn to 1 over n? And we look at the combination of the numerator and the denominator, and it appears that investors who are using this rule seem to have a strong preference for simplicity. That is to say, they are choosing a numerator and a denominator to keep the math extremely simple, buying 2 stocks with a total buy of $2,000 that splits equally to $1,000, or indeed, when spending $3,000, choosing 3 stocks to keep the math extremely simple. It seems that this is a rule that investors who are drawn to simplicity seem to be drawn to use in their behavior. So our paper is going to relate to the broader literature on behavioral finance models, but I think a key distinction what we're doing here is that in the large psychology-based behavioral finance literature, which introduces elements of non-rational behavior in portfolio objectives of investors, investors are nevertheless trying to optimize an overall portfolio, albeit having some behavioral component to the way in which they do so. And there's a number of references here to that literature. What we're doing is maybe taking a slight step further to say, well, investors don't seem to be trying to achieve something in the portfolio, albeit non-rational. Investors instead seem to be more concerned with balanced buying than they are with some kind of portfolio objective. And then our study is also going to relate to the previous literature on 1 over n, on which there is an established literature. So the colleagues in the audience may well be familiar with the DeMiguel paper, which is very well known in behavioral finance, on the 1 over n portfolio balancing heuristic. And the authors show that that heuristic, if applied to a portfolio equal weights across stocks, performs well in practice versus an optimal portfolio strategy, mainly because of the challenges in estimating optimal weights. And there is some evidence that investors have used 1 over n in practice. So the very well-known Bonazzi-Thaler paper that shows evidence of how investors appear to use 1 over n in retirement savings plans. I think the difference in what we're doing compared with, say, the analysis of retirement savings plans is that in retirement savings plans, you make a regular contribution rate and you have a default as to how you're going to split that across stocks. So the choice of contribution rate kind of deeply entangles specific purchase transaction rates to the overall portfolio weights, because you're moving into a default position of making a recurrent purchase using the same weights each month in the buy, which will translate to the portfolio. Whereas here we have quite distinct behavior on the buy side compared to the holding side. And now, given that there's a lot of inertia in retirement investing, it's very difficult to distinguish between the active choice of buying versus the ingredient choice of the default. So we can distinguish between 1 over n as a buying strategy versus a portfolio strategy because of the discreteness of trades that investors make in stocks compared to retirement savings plans. And indeed, one of our main findings is that investors seem to use this as a buying strategy and not a portfolio strategy. So just before I dive into the data and the main results, I don't know if there's any particular questions that have come up so far.
So one kind of general question about this theme is that this 1 over n buying rules may suggest that investors essentially have very little awareness of rebalancing. And so is that something you have looked at? And in your opinion, is there an opportunity to use the concept of rebalancing as an intervention to affect how investors buy assets?
So indeed, I mean, there's quite an established literature that show that investors engaged in the purchase of individual stocks are slow to rebalance or lazily rebalance. What we're going to show in this study is that we find very little evidence examining investors making trades over a 2-year period of investors buying and topping up their positions to try to hit a balanced portfolio. What we're going to show is much more common, as I've said, is investors actually using balance purely for their buying weights, not for their holding weights. I think that there is kind of scope to maybe try to encourage investors to engage in rebalancing. Of course, many of us in the audience would most likely see the solution to much of this as being holding a pre-diversified mutual fund or some other vehicle that essentially achieves the rebalancing for you, if you like. But in our sample, as we'll see, and we're dealing with all the 3 largest stockbrokers in the UK, only 6% of the holdings in the stockbroking firm of individual investors are in mutual funds or ETFs or investment trusts. The vast majority of trades are still in single stocks, and yet we see investors doing very little in the way of portfolio balancing activity.
Great. Thank you.
Great. So I'll continue and stop regularly for any questions that come up. So the data that we use is from Barclays Stockbroking, and it's an individual investor data set, and that provides us a transaction history for about 180,000 accounts over the period to the mid-2010s. Some of these are, of course, dormant accounts, and we find that about 120,000 investors make at least one buy transaction during the period. As I just mentioned, the vast majority of buys are of common stocks. We have individual identifiers to track investors through time that are anonymized, and we can see the settlement prices for individual trades. And our focus in particular is going to be days on which investors make multiple purchases of multiple stocks. So 2 or more common stocks. We're going to call these things multiple stock buy days. And it's not at all uncommon for investors to do this. We have in our sample multiple stock buy days accounting for a little less than 1/3 of the total invested over the period. In the analysis, we're going to use 2 particular samples. We're going to use a sample of all accounts. That's every account that we see open from the start of the period through the data period, but also what we call new accounts. These are accounts that open during the data period. The difference being that for new accounts, we can reconstruct portfolios on a daily basis, whereas for what we call our all accounts sample, we can't do that because this is a transaction data set. So new accounts gives us a more detailed portfolio view than the all accounts sample. So to give you a sense of these investors, I mean, these investors are going to look very similar to the investors in the large brokerage data set or in other data sets in the literature, in that they have reasonably sized portfolios that are very under-diversified. So in our sample, the average age of investor is about age 50. They make buy-day investments with a median of about £7,000, and they trade at the median a little less than every month. In our new account sample, we know a little bit more about these investors. They've held their accounts for about 8 months in total. They have a portfolio value at the median of about £17,000, and they are not very diversified. So at the median, they hold only 5 stocks. And if you go up the distribution of stock holding, even at the 75th percentile, these individuals are only holding 10 stocks. So similar to previous data sets, these investors are really quite under-diversified. It's not at all uncommon to see these investors only holding just a few stocks in the portfolio, despite the portfolio value being quite reasonable in the data. Now, one of the points that we make from the start of the paper is that buying multiple stocks on a given day is not uncommon. As I say, nearly 1/3 of the total value of stocks bought in the period occurs through these multiple stock buy days. And here we see the distribution. It's quite common for investors to buy, say, 2 stocks or 3. Of course, less common for investors to go buy 5, 6 stocks on a particular day. So our interest is in these multiple stock buy days. When investors are buying multiple stocks, how do they split their investments? In particular, do they buy stocks such that their portfolio is balanced, or do they split and balance across purely the buying behavior? And the first thing we show in the paper is this phenomenon of how investors make their allocation decisions across the stocks that they buy on the particular day, which is what we call naive buying diversification. So to do this, we're going to take investors who buy multiple stocks on the same day, most simply 2 stocks, a 2-stock buy day. We'll choose 1 stock at random to be stock A, and we'll calculate the proportion of the buy day investment allocated to that stock. And so we can do this for 2, 3, 4, 5, 6 stocks, picking a stock at random to avoid possible order issues in which stock gets purchased first. And so let's have stock A and stock B. And if we do that, here we take the sample of 2 stock buy days and simply plot a histogram here of the proportion invested in stock A. And you can immediately see the peak in density at that 1/n 50-50 split. Now you can also perceive these peaks at density at 1/3, 2/3 and 2/3, 1/3. And so it seems a not uncommon behavior in this sample when investors are buying 2 stocks is just to make this 50-50 split. And so with 3 stocks, you see that it's the peak in density here, the modal behavior is individuals to invest 1/3 in each stock. And so with 4 stocks, to put approximately 1/4 of their purchases into each stock by value. And so with 5 stocks, to put 1/5 of the value into each stock. So this behavior reflects investors taking a sum to be invested in the day, add say $1,000, and for 2 stocks, simply splitting it evenly between the 2 stocks. Now, of course, the nature of stock prices in limited divisibility of stocks is that investors might not be able to perfectly achieve 1/n. And so when we're calculating the prevalence of 1/n, the indivisibility of individual stocks implies that it might not be perfectly possible. And so we need to kind of estimate the range at which investors might be achieving 1/n. And so we calculate 1/n with some approximate bandwidths. So in the 2 stock example, achieving a bandwidth between 49 and 51%, that is an almost equal allocation between stocks, or widening this to say between 45 to 55% in cases where maybe stocks are particularly indivisible, high price stocks, you can't achieve an even split. And so our bandwidth calculations would indicate that depending on bandwidth number of stocks, somewhere between about 1/3 towards 40% of stock of buy days are days on which individual investors buying multiple stocks use this 1/n heuristic. So it's not at all an uncommon behavior. Now you might say, well, is there a mechanical reason why investors would take $1,000 and split it evenly between 2 stocks? Is this something that the platform might in some way recommend, or is it something that the purchasing journey might deliberately or inadvertently result in? If, say, you put multiple stocks in a basket and then you type in $1,000 and maybe the platform by default would, for 2 stocks, attempt to allocate as close to $500 as possible to each. Well, that isn't the way that the platform works in practice. So there's no recommendation for this. And we have a YouTube video, actually, the buying journey. The way the buying journey works on this platform, as with most platforms, is that you have to go through the purchase of each stock individually. So you allocate, you ask for a stock to purchase, you're quoted a price, you type in an amount you buy, and then you need to do the journey for the next stock. So we don't think there's anything mechanical in terms of the technology or the recommendation that might arise from a stockbroker that's going to cause this. And these are online trades. These aren't in some way advised trades on the phone, where in some way it might be the naive waiting of the broker on the phone who might be recommending this. This seems to be the action of an individual making a number of individual stock purchases. Oh, I noticed that there's some questions in the Q&A, Vitaly. I don't know if now's a great time to take any questions that are arising.
Yeah, so there's one question about, do you know the holdings of individual stocks in comparison with holdings of ETFs or mutual funds? And whether there's different buying behavior for individual stocks versus ETFs and mutual funds?
Okay, so we don't have this in the slides, but if you look up the paper, then we do have a section in the paper on whether investors engage in the same behavior when either buying stocks with mutual funds or buying multiple mutual funds, and they do. You know, in particular, you know, though it might seem quite bizarre, you know, an investor taking $1,000 and investing $500 in an ETF, a well-diversified S&P 500 ETF, and then the other $500 in a single stock. So, you know, we see that kind of behavior. So that's something that we document in the paper.
Great, thank you.
Great.
And then one other question is, so you talk about buy days. Do you have any information on sessions within the day? So
no, we don't have as precise information as to see individuals say timestamps on exact point of their sessions, when the session starts or when the session ends. So we use the day as the unit of observation. We don't know whether they kind of log in at 2 o'clock, make a trade, log out, log it back in again at 2:15, and that was a separate session, or whether that was a single session. I mean, in the paper, we do some analysis where we change the window of observation from a day to be multiple days, or we do multiple stock by weeks or multiple stock by months, I think. This behavior is much more prevalent with stocks being purchased on the same day, but we don't know whether the two on the same day were in exactly the same session, because we don't know when the timing of they kind of logged out and logged back in again to the platform, for example. That we know when the stock was purchased, but not that session type data.
Thank you.
Great. So the next step in our analysis is to ask, well, are investors here trying to engage in a naive diversification of their portfolio holdings, or are they engaging in a naive diversification just of the buying decision? And that's what we look at next, because 1 over n, the literature has shown, is a useful portfolio heuristic, which performs well in practice compared to trying to build an optimal portfolio. And so we're now going to examine what we call naive buying diversification versus naive portfolio diversification in more detail. The way that we start this analysis is by examining what we call top-up buy days. And so these are buy days where investors have stocks in their portfolio, let's say stocks A and B, and they also make purchases of stocks A and B on the day. So naturally, one can ask the question, when the investor goes and makes purchases of A and B, do they do so to bring the portfolio close to balance, which would be naive portfolio diversification, or do they just split that purchase of A and B equally, which would be naive portfolio diversification? And so we look at this as a first case, and what we see, and I can kind of illustrate quite simply graphically here, is that here's a sample of these top-up days, so investors already holding, in this case, the 2 stocks which they purchase on the day. And you can see a common behavior is to make a 50-50 split over the 2 stocks in the weights being used on the day, the $1,000 split in half of $500 of each A and B. And we don't see on the right-hand side much evidence that investors end the day with the portfolio of shares of A and B being in balance. So that's a particular example of where investors are topping up 2 stocks. Now, it might be the case that given the portfolio position, investors might not be able to reach a 1 over n portfolio without spending more than they have on when we see them spend on the day, or indeed selling a position to be able to achieve balance through a higher purchase or a sale, simply because the value of the purchase on the day might not be sufficient to bring the portfolio into balance. And if that were the case, we would be underestimating NPD. So then we also look at that subsample of where NPD is achievable given the amount that was purchased on the day. And here again, we see that splitting on the left-hand side, 50-50 in the 2 stock example, is very common. But achieving 1 over n balance in the portfolio is relatively uncommon. So again, it looks like in this sample where 1 over n portfolio is easier due to the restrictions that we've made, it seems to be an uncommon behavior. And then we broaden out the sample to the full range of days that we observe in the data, including single stock buy days and multiple stock buy days for all combinations of numbers of stocks that individuals hold in the portfolio, and say, well, across the broad span of data, is this a common behavior achieving NPD kind of anywhere in thin or thick portfolios, large or small buy days? And that's what we have in this illustration. And so here in these multi-panel plots, we have each panel representing a number of positions being held at the start of the day. And on the x-axis, a number of stocks purchased on the day. And the red dots give you the proportion of buy days that are NBD, splitting the amount equally on the buy. And the blue are the proportion of the portfolios that subsequently end up being NPD, balancing the portfolio at the end of the day. And you can see, this data now includes all of the data that we use in our analysis. And you can see that across all these different combinations, it's always more common for investors to engage in narrow buying than it is to buy such that they have a balanced portfolio at the end of the day. So this is by far the more prevalent behavior. So investors seem to aim for naive buying diversification, not naive portfolio diversification. And that tells us that they seem to be acting very narrowly, naively diversifying, but on a margin that we might struggle to reconcile with optimal, purely their buying, not their holding. There's little evidence of investors buying such that they achieve naive portfolio diversification. And so we might take a step further and tentatively say that investors appear to have a buy strategy or not a portfolio strategy, or at least if they have a portfolio strategy, it doesn't appear to be 1/n, and it looks at odds with the 1/n buy strategy that they do appear to exhibit. Now, the next step, before we seek to understand why investors are doing NBD, we briefly look at selling behavior and whether individuals are engaged in naive selling in their splitting of their sales of two stocks to equal amounts being sold, for example. And I'll just dwell on this briefly. And the punchline is going to be that investors don't seem to do this. And that's possibly because investors, when selling, are confronted with portfolio information. The portfolio information investors see on screen does seem to matter. Hence, the existence of disposition effects and rank effects. Investors seem to be drawn to particular stocks that they sell on a day. And naive selling diversification is much less common. When we, in brief, look at the splits that investors use when selling, in this case, two stocks on the day, there is some central tendency in the behavior, but that spike at 50-50 that accounted for nearly 40% of trades when buying is not a higher spike that we see when selling. So there is some evidence of this behavior, but not to the same magnitude as when investors are buying multiple stocks. So it's present, but not by any means as common as naive buying diversification. And so we don't dwell on this naive selling behavior in the paper further. So now we try to understand why investors are using this heuristic. And as I mentioned at the top, there are these two hypotheses we consider, what we call stock picking, whereby investors seem drawn to stocks, as the previous literature suggests, as a reason why individuals hold only a few stocks in their portfolio. They seem to be drawn to the salient characteristics of particular stocks. And they don't make an active choice to diversify, choosing NBD as a simple heuristic. Contrast that with the psychology of being drawn to an individual stock and then deciding, well, I'd better buy something else as well to diversify. And I try to buy something different, and then I use a naive weighting rule because I don't have a more sophisticated weighting rule in mind. The second example, the investor is trying to diversify. In the first example, the investor doesn't seem to be focused on diversification at all. Now, these two distinct hypotheses, which are in tension with one another, yield testable implication, because under the stock picking hypothesis, naive buying diversification is occurring when investors are buying similar stocks that they're drawn to on the day, whereas under the diversification motive hypothesis, NBD should be more common when investors are buying different stocks because they are trying to diversify by choosing a different stock, albeit in a naive way. And so therefore, we examine whether NBD is more or less common when investors are buying more or less similar stocks. And to measure stock similarity, we use a number of measures, some from the previous literature and some using new data. So we look at the idiosyncratic volatility of stocks, whether it's correlated across stocks. We look at past returns. We look at future returns. We also match in some new salience data using the Thomson Reuters Market Psych Index, which is a index of the news coverage that a stock receives on a given day, what they call the buzz index. And some stocks have a high newsworthy score on a particular day because they've made the news. Other stocks have little news and so are a low buzz score on a particular day. And we calculate the difference in the share of daily buzz accounted for by each stock to see whether investors are maybe drawn to two stocks in the news and buy both of those, or maybe investors are drawn to a stock in the news and then go and buy a stock that isn't in the news, which would suggest that they are looking for some other characteristic of the stock. And we can do this with each of these measures. And what we find is that NBD is more common when the multiple stocks being purchased are similar. And that seems to be consistent with the stock picking hypothesis against the diversification motive hypothesis, which would suggest that these investors are trying to pick different stocks. And so in these plots, we have on the y-axis the proportion of this 1/n buying, NBD, in the multiple stock buys on the day. And on the x-axis, we have the difference between the two stocks on the left-hand side and the difference in the proportion of buzz, how much news coverage they garner in the day. In the right-hand side, the difference in the idiosyncratic volatility of these stocks. And you can see that NBD is more common when these stocks are more similar, and conversely to the right-hand side, you see less common, the decay when the stocks are different. And therefore, it seems to not be the case that investors are using NBD in situations where they're trying to diversify by buying different stocks. We also see these same patterns in past returns and future returns when comparing those across the multiple stocks. And that persists in some regression analysis where we find that NBD is less likely when the stocks are more different as measured by the difference in these observable characteristics. So it seems that investors are not attempting to diversify in an active choice of their stock picking when using this heuristic, but instead use this heuristic when buying very similar stocks. So in the last few sections of the seminars, in the last 10 minutes or so, I'm going to talk about portfolio performance and then what we can learn about why investors might be using this very simple rule. So NBD might matter for portfolio performance because ultimately we would think that investors should be concerned with the mean variance performance of their portfolio, or at least the simple performance of their portfolio. And NBD could impact upon portfolio performance, and because in particular, when stocks are very different in their idiosyncratic risk over a period of time, the problem with using NBD is that you're not bringing your portfolio into balance by adjusting your portfolio position to bring 1 over n weights. Instead, you're only bringing your buy into balance. Now, to evaluate the portfolio performance that arises from using these types of heuristic, we have to ask what's the relevant measure of performance to these investors. Now, I mentioned risk-adjusted returns. You might say, well, given everything I've said in the seminar so far about these investors who hold few stocks and use naive diversification rules and appear to be picking stocks, it seems unlikely that they're concerned with risk-adjusted returns. So to examine portfolio performance, we both consider a very simple measure of average unadjusted returns across different groups of investors in our sample. And then we use a Sharpe ratio measure of returns, risk-adjusted returns, simulating portfolio performance under NBD versus NPD, calibrating our simulation from the data following the simulation that's used in DeMiguel and co-authors to try to understand when NBD is going to perform better or worse compared to NPD in different settings in which stocks have large or greater or less idiosyncratic risk and over shorter or longer time periods. And so what we find through simple observation of the portfolio performance of these investors by their average unadjusted returns is that the returns that we see achieved by investors using naive buying diversification are on average lower than those investors who never use naive buying diversification. So on the left-hand side of the plots here, we have cases where investors engage in NBD in 50% or more of their trades, or in the middle plot, at least one of their trades, or to the right-hand side on the plot, those who never engage in NBD. And it seems that investors that never engage in NBD achieve better returns than investors who engage in NBD. So that suggests that this kind of rule is potentially used by investors who are achieving worse portfolio performance. But to simulate out whether NBD is going to achieve better or worse performance than NPD in practice, we use the single factor model as in DeMiguel et al. And evaluate Sharpe ratios as simulated out of that model. So an important ingredient into this single factor model is, of course, idiosyncratic volatility. And to make the rather obvious point, with zero idiosyncratic volatility, NBD would equate with NPD. At the limit, if the two stocks are indeed one and the same stock, it doesn't matter whether you're buying equal weights or whether you are trying to achieve equal weights in your portfolio holdings. The two things are one and the same. But of course, as idiosyncratic volatility increases, NBD and NPD strategies are going to diverge. Because if I initially buy with equal weights to achieve NPD, then the idiosyncratic volatility will cause these stocks to diverge in their portfolio shares, and an NPD target would rebalance. But if I simply continue to buy the same amount through NBD of each stock, then my portfolio is not going to be rebalanced as if I tried to rebalance the portfolio through my trading positions. In some cases, it might become further from balance through my buying decisions. And that's going to be the crux of what we learn from the simulations, because we're going to present simulations with high and low idiosyncratic volatility, calibrated to the observed levels of volatility in the data to show us something about how these portfolio rules perform in practice in the range of volatility we observe. And we're going to see that NBD performs worse when idiosyncratic volatility is high over longer periods of time as the portfolio has longer to diverge. And so our results that report Sharpe ratios over calibrations with low idiosyncratic risk and high idiosyncratic risk with different numbers of stocks, N, and different time periods, T, show in particular in the bottom panel that when there's high idiosyncratic volatility over longer periods of time with large number of stocks, these two potential rules deliver different portfolio performance. In particular here, NBD is inferior to NPD. And that's because of this phenomenon that with high idiosyncratic risk, NBD is not trying to bring your portfolio back into balance, where of course NPD is a strategy targeting exactly that balance in the portfolio position. And so that's when this is going to be a particularly costly behavior to investors in terms of their risk behavior when these stocks have higher idiosyncratic risk and are held for longer periods of time. Now, then we might say, well, that simulation is indeed the case, but if we see in the data that NBD, that investors reduce their use of NBD when idiosyncratic volatility is high, then maybe investors are indeed mindful of this. And in periods of high idiosyncratic volatility, they're less likely to use this really naive buying weights. So investors might effectively moderate their use of NBD to mitigate this risk. And so we examine 1/n trading patterns against FTSE 100 volatility as a measure of idiosyncratic volatility. And what we observe here is that the proportion of 1/n buying, or the average investment amount of 1/n buying, so that's the proportion of trades that 1/n, or the average amount spent when investors are engaging in 1/n, appears to be invariant to the volatility of the index. So in times of particular high volatility, investors are just as commonly using NBD or just as commonly investing the same amount in NBD investments. So investors don't seem to cut this behavior when the idiosyncratic risk is high. So just in the last couple of minutes, because my time is nearly gone, I'm going to talk a little bit about why investors might be using this rule. In particular, why they're using such a simple rule. And we'll ask, does NBD occur due to a preference for simplicity? And there's some suggestive evidence that this is the case, because investors seem to choose the numerator and the denominator of 1/n to keep the math very simple. That is, when they spend $1,000, they're more likely to split it two ways, $500 of each, whereas when they're spending, say, $3,000, they're more likely to split it three ways, $1,000 of each, to keep the math very simple. They seem to choose the numerator and the denominator to achieve simple integer ratios out of their decisions. So here you can see, for example, the distribution of the total amount invested when buying two stocks. The total amount invested seems to be a number that splits easily by two into integer value. So we've got 1,000, 2,000, 4,000, 10,000, 20,000. When investors are buying three stocks, in contrast, they seem to use numbers that divide simply by 3, 1,500, 3,000, 6,000, 9,000. You don't see the same peaks at the 1,000, 2,000, 4,000, so on. And of course, we see this when investors are buying 4 stocks or when investors are buying 5 stocks. And so the use of NBD is possibly linked to just a preference for simplicity in the purchasing decisions of the investors. Now, we don't have exogenous variation in the numerator or the denominator, so we can't experiment on investors by changing the amount invested and seeing if they alter the number of stocks they buy, or indeed experiment on the number of stocks that they buy and see if they change the amount they invest. But these patterns seem very strongly suggestive that investors are using this rule in such a way to keep the math simple, suggesting that they have a very strong preference for simplicity. And indeed, this results in a phenomenon that the mean amount invested on the day, as that rises and the number of stocks rises, the average amount invested to each stock is very steady across investors. Now, we've checked that this doesn't arise simply by investors buying fixed amounts per trade. You might say, well, NBD could arise because investors only ever spend $1,000 in each stock. And so when they buy 2 stocks, they spend 2,000. And when they buy 3 stocks, they spend 3,000, and so on and so forth. And so actually this wholly just reduces to a phenomenon of investors always spending the same amount when buying a stock. That is, NBD could arise if investors always buy in fixed amounts per trade. But actually we can reject this hypothesis, because if we look at investors who at least have a denominator that differs at least once between their trades, then we find that only 2.3% of investors spend the same amount per trade. So we don't think this is simply reduces to investors always buying the same amount when they make a trade. So I shall conclude here because my time is indeed gone. The main finding of our paper is that investors often use a naive buying diversification heuristic. And this is a new finding about the way that investors relate their buying behavior to their portfolio behavior, indicating that they seem to behave very narrowly, separating their buying weights from any kind of portfolio weights, naively diversifying over what they buy, apparently not concerned with the weights of what they hold. We'll find that investors engage in NBD and indeed not in naive portfolio diversification. And this seems to arise because of a preference that investors have for simplicity, choosing the numerator and the denominator to make the math simple. So investors are acting surprisingly narrowly in the diversification choices of the stocks that they buy. And we would say that in existing studies in behavioral finance don't tend to capture this narrow framing, because as I mentioned at the top, existing studies tend to assume that behavioral investors nevertheless are trying to optimize a portfolio. Our empirical studies suggest that investors don't seem to have a portfolio in mind. And just as I finished in the last couple of sentences here, I think it's very interesting to think about why investors might be using such simple rules. And to bring it to the topic of financial literacy, which obviously is a privilege to talk in a seminar series of this centre that's made such a big contribution to the literature on financial literacy, in which I've participated some of my own work. I think one thing to maybe think about in future is, well, if investors have poor financial literacy, and we know that that leads to some behaviours like limited stock market participation and limited diversification, it would kind of raise the question of maybe what types of heuristics or rules do investors with limited literacy turn to or use? And so I'd be quite interested to know whether some of these simple heuristics, and in my other work on credit card repayments, we found consumers using very simple heuristics to determine how they repay their debts across credit cards. Do those heuristics arise as a result of investors maybe with poor literacy trying to turn to some rule to govern their behavior, some rule of thumb in what they should do? Maybe that's a source of what we see occurring here. Maybe that's a source of what we see occurring in other domains. So I'd be very interested to think about the relationship between financial literacy and heuristic type behaviors among individuals who don't have the literacy to behave in a more sophisticated way. Great, thank you so much, Vital. I don't know if you want to bring up any of the questions that might have come in the last part of the seminar.
Thank you so much, John. We have a few minutes for Q&A, so I'll just read a few of them. So one is, so it looks like from table 2 of the paper that the propensity to engage in NBD is unrelated to a person's age, gender, or account tenure, which is somewhat surprising. So could you elaborate a little bit about why you think that might be the case?
Right. So we have some characteristics that from which we can measure individual observables. So we know something about their portfolio age. We know their gender, although these investors are predominantly male, and we know some other elements of their characteristics. And we don't find particularly strong gradients to explain a role for say demographics or other characteristics in determining this behavior. It may be the case that the individual investors of the type who are those that choose particular stocks are not a sample among which those covariates would lead to variation in observed behavior. So there may be differences in the diversification decisions of individuals by age or by income, or indeed by measures of education, but among individuals who choose to participate in individual stock purchasing behavior, that might not be a relevant variance on which we observe the behavior changing. So I think that maybe the question is, given in other studies you see that these characteristics really important for explaining variation behavior. Why don't you see that here? And that may be because of something about the type of individual who selects into purchasing individual stocks in their investment portfolio. But we don't. The observation is absolutely right. We don't see strong gradients in those covariates.
Since you find that NBD results in worse portfolio performance, are there interventions that you think would be helpful to encourage investors to not engage in NBD?
So I think when one is engaged in this literature, investors one sees investors who appear to be some distance from the much closer to optimal portfolios that are far more easily achievable through buying pre-diversified products. And so you can look at this type of sample and kind of ask the question, well, why aren't these investors buying ETFs, mutual funds, and such the like? And so I think that's always the first reaction I have to these type of samples of investors. But I think the point is well taken on the particular issue of weighting, that these investors, I think, probably don't have diversification in mind. I think that's what we've shown in the paper. They don't seem to be buying combinations of stocks that are different. They seem to be applying this rule only to their buys. So the kind of intervention that one needs potentially for these investors to explain or to encourage diversification is probably extremely basic, about trying to help investors to understand the basic tenets of diversification and why it is better to diversify across stocks and then to try to rebalance across stocks. So kind of one naturally thinks of quite basic educational kind of interventions, because these, it's not that we see a suite of more or less sophisticated diversification rules and our investors are towards the less sophisticated end. It seems much more basic than that. These investors don't even seem to be targeting a portfolio. So it's obviously a very basic level of intervention, or an intervention to achieve some basic understanding of diversification, I think is probably needed here in this sample. But this is not inconsistent with what we see in many other samples, where investors are choosing very few stocks and are rebalancing quite lazily. So this seems to be a broad phenomenon that one sees in samples of individual investors.
And so just to follow up on that, so if an investor is going to engage in NBD, would their portfolios perform better if they purchased ETFs and mutual funds instead of individual stocks?
Oh, well, absolutely. I mean, if you the difference between buying two stocks with even the most sophisticated weights that one could think of rebalancing very regularly, compared to just buying two mutual funds, then with any weights, the mutual funds will outperform, because the degree of diversification that you get. If I go and buy an S&P 500 and a FTSE All World Index, whatever weights I choose, I mean, I've got two exceptionally diversified products there. Whereas if I go and buy two individual stocks, as I say, I'm taking enormous amounts of risk, even if I kind of trying to recalibrate my weights and bring my portfolio into balance very, very regularly. So if investors were naively weighting their ETFs, that would have very different implications to if they are naively weighting individual stocks. The margin of naively weighting ETFs wouldn't really matter hardly at all, given the high degree of diversification in those products. If indeed one is using an index, an index-based ETF.
Great. Well, thank you very much. I think that's all we have, all the questions that were asked, and I think Anna Maria has some more.
Yeah, thank you. And I think we can, if you can maybe stop the sharing, so we can actually.
Thanks,
okay, wonderful. Thank you. Thank you so much, John. I have to say, I was alarmed as you were, continuing your presentations, to kind of see this finding. And, I think this paper just is so important, documenting that, what we see, as you said, it's not even an attempt to diversify, right? So, while we think that diversification is one of the most important principles for investing. In fact, the behavior doesn't even point to that. And I think you have given us another very interesting data to look at this 1/n, which is not kind of an attempting even to do that, but in the way people are looking at stocks. And I do find very compelling, I have to say, but I am surely biased, that perhaps some financial literacy might play a role here, given the simplicity of the role that they are choosing. And I think some of your graphs are unique graphs, like how people are dividing this in this simple way is really unique. And so kudos to you also to the data and so on. And, I just, it really worries me, for example, in this moment of deep market volatility, what will happen to this portfolio. So maybe that's another, great things that you can do with this data. How do this portfolio perform in this very unusual environment where the market can take a deep dive and then come back right away? But how do these people who use these very simple rules that are not diversified at all are going to deal with this? So you have given us, I think, an incredible set of information and data and findings that make us think a lot more. And I am currently teaching personal finance, and my students are taking an exam at this moment. So I have been keeping an eye on them as well. And I just think, more than ever, we need to add one more class, maybe on portfolio diversification, just in case they didn't get all of the formula, or just in case, they are actually going to do investors in single stocks and so on. And I was also taken by the fact that the demographics that do not seem to explain much, that is not just young people doing this. So let me again thank you very much for being here today, for presenting this paper. One of the advantages perhaps of being online is that we can get speakers like you, who are connecting late in the evening. So thank you for your generosity of the time, but we can have you connect from the UK to here and tell us, what's happening in your new research. Also, I want to invite people to read the great work that John has been doing, for example, also on debt and debt behavior. So I think, John, you are documenting a lot of, puzzles and a lot of interesting behavior across the financial decisions that people make. And this is why we are so delighted to have you here in the Financial Literacy Seminar. So
it's an absolute pleasure. Thank you so much, Anna-Maria. Thank you.
Thank you. Thank you again. I also want to tell everybody that, we are posting the paper, hopefully the presentation, if you allow us. And so for those, who want to have more information, it will be posted on the website. And we have a few more speakers. So please join us again for our next speaker. And let me thank you again, John, for being with us today and for this great presentation and for staying up late in the evening to join the Financial Literacy Seminar series.
It was a pleasure. Thank you so much.
Thank you. Thank you. Bye-bye.
Bye-bye.